May I welcome my fellow panelists. We'll start with Ramon Zabarte from NatWest, Commercial and Institutional Business. He leads the business. My next panelist is Shubham Jain, who heads B2B and SME Enablement at Mastercard Move. Welcome, Shubham. May I welcome Vibhor Narang, who is our Executive Director for Payments and Trade at Standard Chartered. And my next panelist is Himanshu Joshi, Managing Director of Strategic Partnerships at Lloyds. Last but not the least, may I welcome Borna Lujanek, Partner and Chief Growth Officer for Intellect. Very, very warm welcome, gentlemen. So it's always been a pleasure to discuss transaction banking, something which is very close to my heart. Transaction Banking Center of Excellence at CEDA as part of my responsibilities. So we'll start always with banker Himanshu. We'll start with you. Transaction banking has always been seen as a cornerstone of corporate banking, building clients, revenues, fee incomes, which helps banks in times of growth, in times of higher interest rates, and so on and so forth. How do you see it's going to change, and how do you stop it from becoming commoditizing, because it remains the same over the years, and the level of innovation, and how do you differentiate yourself from Lloyd's perspective?
Well, first of all, thanks for having me here, or rather thanks for having all of us here, and thanks to all of you for taking the time. I would say this question is a classic. It has been asked before, and I know why it has been asked. If you look at transaction banking from a very traditional lens, and that is transaction banking providing standard set of products with fairly standardized plumbing and the standard set of rails, it's not unreasonable to ask that question. And if we overlay that with the standardization we are seeing across technology, standardization of margins, thanks to margin compressions, and also standardization of the regulatory framework. All of these aspects are leading us towards commoditization of services which are provided by transaction banking. So if a financial institution wants to play a passive role in providing these services as standard, then yes, we do run a risk of transaction banking being seen or being perceived as a utility business. But, and here comes the but, this is only half of the story. I believe transaction banking has never been as strategically important as it has always been. Now let's look at the factors that why transaction banking is evolving and why it will continue to remain relevant. The two aspects which I want to talk about are our clients and the correlation with the macroeconomic environment. So the way our clients operate their business and their expectations from the financial institutions has changed considerably over time. They do not expect us to just be a service provider. They want financial institutions to be strategic enabler. And I think the word I took away from the previous panel was embedded. Being embedded, providing data-driven insights to them. Now, if we overlay that with the macroeconomic environment, I think it's already been talked about. The environment is complex, full of uncertainty was another word, owing to the trade wars we saw earlier, owing to the geopolitical conflict, and also the disruption caused by technology. So at this time, what our clients need, they need trust, which has been widely spoken in the previous panel. They need resilience, and they need strategic advisory. So coming to transaction banking being sat at the intersection of different sets of data. And when I say different sets, this is data at rest, transactional data in motion, even the synthetic data, trying to stay away from AI. but leveraging that data, providing insights, recommendation, which could drive the decisions, which could enable our clients to make not only decisions about their strategy, their policies, but also their flow. So this is about transaction banking. Now I'm looking at the other side. Transaction banking is great, but I don't believe any financial institution can do this alone. And that's where the concept of strategic partnerships come into picture. And I have to talk about strategic partnerships given that's what I represent for Lloyds as well. Strategic partnerships for me is a key enabler. Through strategic partnerships, what we want to do is we want to collaborate with partners across the industry and bring it all together, whether presenting the solution to our clients in their ecosystem, in their environment, or creating a new solution to an existing problem. So to sum up my argument, I would say transaction banking has always been an anchor and will continue to be the anchor of the relationship between our clients and corporate banking. And it will continue to play a strategic role as long as financial institutions are serving our clients the way they need to be served today.
Excellent. So it's embedded banking and strategic partnerships. Both are quite unique in each bank and how they look at. So it'll be interesting to hear some of the fellow colleagues' perspectives. So Vibhor, I'll go next to you. And representing Standard Chartered, looking at the Treasury again, somebody said in the first panel, FX was based in London and it started in London. How do you see the trade and especially with corridors moving? And in the times of war and global volatility, the flows changing, supply chains challenged in a big way. How do you see the transaction banking is going to change for corporate clients and more from an Asian and a global bank's perspective?
Thank you. I mean, that's something which is very relevant and very apt at the moment, and given the fact that there's a lot happening across, particularly from a geopolitics perspective, but I would rather see it as a trend being there for the last 10 years or so. We have got COVID, and before that there has been multiple other pieces, which is still fresh in our memory. So there is a definite shift in the trade corridors as such, which I deal with lots of corporate clients on a day-to-day basis, which I clearly see a trend that there's a growing trend where customers are moving from their China strategy to China plus one or China plus N strategy. What does that mean is where China has grown up as the manufacturing capital, as the consumer capital of the world, but that is something which is now being shifted because of multiple regulatory pressures, trade pressures, and also governmental pressures, and the risk is being diversified towards multiple other countries as such. Now, seeing the opportunity, there are other corridors which have now stepped up and they have now started opening their venues for the corporates to come and create those supply chains, and also there are lots of consumer groups. So, for example, Singapore is now also offering lots of tax swaps, which can reduce up to say 7 to 8% in some special cases. India Gift City is a story right now which quite a few of you can relate to, where extended tax swaps are there for a lot of time. So that's something which is happening from a trade corridor perspective. Now, what is the impact on the transaction banking? Clearly, this has really impacted on how the transaction banking is done historically and now where we need to change. Working capital is no longer, treasury level discussion, it's a board level discussion now. So we talk about liquidity optimization, where you need to have the right level of liquidity in the right currency in the right time. Cliched, but it's very, very true. And banks are actually helping the corporates to achieve that with responding with the right kind of products, liquidity structures, etc. Also important is, because of these corridors shift, there are lots of emerging markets which have, as I said earlier, that raised their hands and opening up their systems. But regulators in those markets are yet to catch up with the trend. So still we see that there are markets which have got lots of manufacturing going into those markets, and also consumers in those markets, particularly Asian corridors. But still, they are having some capital controls and some exchange level controls. So it's easy to put money into that particular market, but it's very difficult to take money out of that particular market. So when you talk about corridor and headquarter clients which are sitting in Europe, what we call it as trapped cash. So the cash gets trapped in those locations. It's not that easy to take money out from that particular locations. Then it comes to the technology, and technology is a broad term. Now I see technology in two different lenses. One is transformative, other is disruptive. So when it comes to the whole transformative piece, the whole real time and immediate instant revolution is there, where the existing payment rails are now gradually shifting towards instant payment rails. We are talking about APIs, we are talking about dashboards which actually give the liquidity information at the flash of a second. So the existing ecosystem which is there, it is now moving on to the next level, getting more digitized. When it comes to the whole disruptive piece, that means the new technologies coming and changing the overall ecosystem as such. That's where we see that the emergence of, we have been speaking since morning about the whole AI piece, but also digital assets. It's getting extremely important, and lots of treasurers are getting now curious about how I can move money across my company through the help of tokenized assets. How can I deploy blockchain into not only tokenizing the money part of it, but also the asset part of it? And then the emergence of AI. Now, there has been a lot talk about AI since morning, and AI, which we have been seeing more adopted in more from a retail and consumer banking perspective. It is now gaining more traction in the corporate banking space. When it comes to treasurers, we need to be aware that the amount of money that the treasurer moves is much more than the balance sheet of the company itself. So that is where the whole risk element comes into the picture. So there is a slow adoption, but what we are seeing there is that there are efficiency-based adoptions which are now getting embraced earlier rather than the transaction-based adoption. So that might take some more time. And finally, as Himanshu also mentioned, resilience in a context, but resiliency is important. That suddenly there is a trade embargo, suddenly there is a war which is being erupted somewhere, or there is some sanctions somewhere in that country. How quickly treasurers can actually take that whole account structure out of that country and put it into a new country and start working on that. That is where whosoever is able to provide that particular piece will be the ultimate winner when it comes to the overall treasury piece.
That's very interesting perspective. Yeah, especially the China plus one, trap cash. There's a completely new thinking around digital assets, which everyone has to start looking at it. And of course, the resiliency times. Shubham, I'll go next to you. You heard your fellow bankers' treasury perspective, you heard partnership perspective. Traditionally, we've always observed, right? It's B2C first, it's consumer payments first. Business payments have always lagged behind in terms of innovation, in terms of what it has done for the businesses and the treasurers. How are you seeing this change? And what are the use cases you are seeing, given most global organizations are investing in payment infrastructures? Banks have been hugely going for smarter payments. If you can give a perspective from Mastercard, Move perspective, as well as your personal view, what you've seen over the decade, how payments have shifted for businesses.
Thank you, and firstly, morning everyone, and very pleased to be here. Thanks for the invite. Great to see people from the industry, some panelists, co-workers as well here, ex-colleagues. Look, I'm not going to use the dreaded two-letter words. I'll probably start with, let's talk about cricket, because it's cricket season. It doesn't look by the weather. T20, revolutionary in the game today, but Test cricket, more traditional. That's how I look at consumer and business payments. To me, consumer payments is akin to the T20 format, flashy, fast, just looks cool. But Test cricket has more nuances, more complex. Just like it's intertwined with conditions, you've got business payments intertwined with regulations, with compliance, with liquidity, with FX. So to me, I think what's happening is because of technology and fintechs traditional banks, I mean, this has been passé now, but they're being challenged to provide the same convenience and experience that you're getting with consumer payments. Wallet solutions are a great example, particularly for SMEs, where if I, as an individual, can transact freely and move money overseas, why can I not do that on the business side of it? So, I mean, I've seen, I would say, a couple of trends which are notable. One is that business payments, the more when you look at SMEs and corporates in general, they are becoming invisible or embedded, be it into ERPs, be it into marketplaces. So it's more gradually of an afterthought. And it's imperative that banks or service providers keep that end customer experience in mind to have that kind of end-to-end view with customer experience as paramount. The second thing, important point, is that traditionally it was always about providing options to move out money, and Mastercard Move has been at the forefront of it. Our extended network and reach is testament to that. But when you look at SMEs, small corporates, they want money in as well as money out, and they want all of that packaged with the ability to do FX, hold liquidity, manage working capital, earn interest, all of that wrapped around a single integrated yet modular solution. And that's where I think a lot of fintechs and challenger banks have come up and trying to solve that problem. And the third part is around, obviously we've spoken about stablecoin, AI. It's going to become an important part of your toolkit, of any banking toolkit in the next few years, but not for every problem. I think there's a different solution for every use case. So when you look at digital assets, tokenized deposits, think about 24/7 settlement, think about managing depletions, harmonizing treasuries. That's where I think combination of these really, it's ultimately going to be thinking about workflows and value chains as opposed to just thinking about, hey, we're a bank or we're a company building 10 different products, right? You need to keep what workflow you're trying to solve for the customer. That's what we're trying to do. At Mastercard, we work with a number of banks, both as customers, as partners. We co-own multiple complex networks, and it's to bring kind of that end customer experience harmonized with the local network nuances.
So again, Mastercard perspective comes to the same embedded payments which we heard in the first panel, and bringing the workflows and very different way to pay. Ramon, you heard fellow bankers, you heard Mastercard perspective. I'm sure NatWest have been investing heavily into the payments. Everyone has invested in last 18 months on ISO 20022 compliance for first phase of 101, 202 messages, and now we have to do further investments. At the end of the day, it's payment is a payment. And how does one differentiates or brings a competitive advantage? So if you can give your NatWest perspective and see, are all of these investments making sense?
Okay, thank you, and thank you again for inviting me, and it's my pleasure to be here to share with you some ideas. The interesting thing about ISO 20022 is that I think the industry as a whole has adopted very different approaches to what you might call compliance. Okay, and it really only is two main payment messages right now. What was the MT103 and the 202, and going into the PAX 8 and the PAX 9. But the reality is, it's just the beginning, right? We got through a big hump at the end of last year, and it's just the beginning of what we can do. What do these new payment messages mean? The money kept flowing, by the way. Everybody, there was no issues. Money kept flowing. So the movement of the money was never the problem. It was the data that was attached to the money, okay, and the variability of the way customers move money or receive money that has always been the challenge. Right? We don't have liquidity management or liquidity forecasting because there's easy one-to-one matches between payments. Okay, there's all sorts of behaviours within the industry and that the banks have traditionally been blind to that could otherwise be solved by the additional data available with ISO. So whilst I and some of us may be finished our journey on ISO 20022 as a project and a concept, I think it will carry on for several years to come, and there are definitely more compliance dates to happen. But really, what does it matter? How do we differentiate? I think initially differentiation is going to happen with speed of adoption of these new formats. I had the great pleasure of meeting with Borna beforehand, by luck only. And one of the things I hate to use this jargon, but one of the most glorious new message types is in fact the CAMT54, okay, which is the advice message type, and it is super rich, right? 750 possible data points that can exist. Customers, in the current world, that's 5 data blocks. Now 750 possible data points that we can carry for our customers. And my guess is that most banks are making priority calls on what data to carry, okay? Simply because their underlying systems can't carry them all, okay? So that's quite an interesting sort of battleground. What does that mean though? It means how deep can you be embedded? We've talked about it before. If you can be embedded carrying 750 data points versus the next guy with 50 data points, maybe you're doing better, who knows? So that's one. That's number two, if you like, in the way of thinking about it. And number 3 really is, what other data points are required to satisfactorily serve a client? Okay. What do I mean by that? In fact, it's not just moving money. It's opening accounts, closing accounts, getting through KYC, KYB, all of these aspects of doing banking, doing business with banks through data that really are the battleground for innovation and also engagement with our customers. So I think we're really only at the beginning. I think standardization, whilst it sounds a bit boring, is actually quite an important differentiator and battleground in the near term, probably for some time to come. But ultimately, really, it's how much we understand about our customers, and therefore how do we prioritize what we deliver to them in these API-driven ways, these embedded ways. And I think that it's quite a vibrant and interesting market to review, because not all banks are computing the same way.
So that's quite fantastic, Ramon, giving a very different perspective. As there are bankers in the room with the businesses, now you know the level of data which messages will carry or payment messages will carry, and can allow you to differentiate and prioritize, right? So that's the key message. Well, now you've been listening to local banks, you've been listening to global bank, and you've been meeting clients across. Given banks are very clear that they want to differentiate, at the same time they want to standardize, they want partners to come in and collaborate with them with strategic partnership. Looking at all of this and looking at it from an intellect perspective, which is one of the market leader when it comes to transaction banking systems, how do you think banks can collaborate with the players like yours to help differentiate faster, given the rich experience you guys carry?
Thank you, Chetan. I will be provocative. At the moment, what our clients, what industry needs, is a very disconnected to what we as bankers, I'm ex-banker, 20 years banking provide. So industry does not operate through banking products. Industry operates through workflows, industry operates through events, industry operates through operational models, industry operates through value chains, through supply chains. So there is a huge dichotomy. Now, the relationship between the banks and technology vendors. The successful banks right now do not view technology providers as vendors. So successful banks right now see technology providers as partners and as a co-creators of a new operational business models. So these banks do not buy software from technology companies. They buy innovation or access to the innovation ecosystems, and they buy co-creation of business models. So to put it straightforwardly and simply, these fast movers and successful banks do three things differently. The first thing is when they want to choose technology partner and they start to want to transform something. The first point, they start from the business outcomes. So the conversation is not about what feature functionalities you have, etc., what will be the conversation. True conversation starts with what is the business objective of the bank in this particular area. We heard before, I'm impressed with the previous panels. It's one of the most profound panels I've witnessed in the last 12 months. So they start with what is the business objective? Which problems I need to solve for my clients? Is it the ecosystem? Is it liquidity? Is it trade finance? Enabling trade finance? Yeah? Is it managing international liquidity? So those are the type of conversations you have and they have with the business vendors. And then it translates down to the solution or the design of the solution. The second point they do differently is they co-create. We heard this from Charles, from James, and from the gentleman here. So what they co-create with technology partners, they co-create with the consultants they have. When you find 80% of the consultancy projects fail in the final implementation. Fantastic strategy, not implementable. They co-create at the same time with cloud providers. They co-create at the same time with smaller fintech vendors. Yeah. So the projects, transformational projects, are not very linear and not driven by specifications, driven how we create value. The third thing they do is they source innovation and solutions globally and implement locally. We heard this in the previous comments. Yeah? So then the question is here: if you're a global bank, it's easier. We operate in 60 markets, fine. But what if you're local? Now, here you can also leverage your technology partners to bring to you the best practices across different geographies, which can be implemented locally. So in this part, I would conclude with the following. So, how to thrive, how to win. As an ex-banker who ran local and international business, there was always mantra, especially in the corporate banking and transaction banking. We have to maximize share of wallet. Not true anymore. If you want to be successful, you have to maximize share of ecosystem you serve. And so you should not maximize particular client. You should maximize within the bigger client or a smaller client and the particular ecosystem you serve. You should maximize your share there through the innovation, through the collaboration.
Excellent, Bonas. So that's co-creation, right? Which is what most fintech partners would love to hear from the bankers. So I'll just go around asking a question on behalf of everyone here. With next 5 years in a post-war, post-oil recovery situation, what do you see as a transaction bankers? Just one key bet which banks should put on to ensure that they are able to define them as a winner for the next 5 years, right? So I just need one word from each one of you, and you've heard many concepts since morning, so I'm sure I have a different perspectives from different people. I'll start with Raman, you, and then maybe you can continue with.
Yeah. Okay, just very quickly, automated cash management. Yeah, it's not one word, it's a few words. But I think that the important point to think about is it is here now, but how does a bank deliver it to its customers well and controlled and appropriately with AI? Because I don't know that we have the people yet in the industry that can do it.
Simple word, automated cash management. Shubham?
Yeah, from from a business payment perspective or generally any international payments, orchestration. To me, orchestration is going to be the next big bet. We're already seeing that happening, but more than even having plumbing and pipes, orchestration across different products, SWIFT, ACH, RTP, stablecoin, cards, wallets. How do you provide that unified and maneuver across these different methods of payment, rails and schemes? That's what we're going to see. That is going to become the new reality.
Interesting. Orchestration. Vibhor?
Ecosystem. Now, ecosystem is going to define who is successful or not. And just 2 cents on that, ecosystem is not just about banks and fintechs. It's not just about technologists. It's not just about creation of those investments into the system. But ecosystem is also about regulators. Ecosystem is also about a compliance person in the bank. It's also about a risk person, and more importantly, it's about the operations person in the bank. So if you have all these coming together at the very early stage, something that we call in Standard Chartered language as PLC, Product Lifecycle Technology, where all of these get involved in the stage 1 and 2 of the product development, that's actually going to decide that yes, whether the innovation is successful or not. Because one person somewhere in stage 8 may raise his or her hand and say that, oh, by the way, I don't understand, so let's abandon that. And I have seen projects getting derailed in that. And sorry, just one extra thing which I would also like to add, and when we speak about this whole AI piece, is skill development. That is one thing which is one of the most underrated discussion points in many of these panels, because I have seen people like in treasurers, when I speak to them, they don't understand AI. When I speak to somebody in innovations team in their organization, they don't understand treasury. So we need people who actually understand everything together, and that's where is going to decide the success for a particular organization.
Very interesting. I think the skill development maybe is a better along with the ecosystem. Himanshu?
Really like that, the ecosystem aspect. So I'm going to give you that one word, but you have to bear with me for 30 to 60 seconds here. So we just did a transaction banking conference, and we got a few hundred clients across that Lloyds 3 days back. The 3 key themes which emerged out of it, one was open banking, second one was embedded finance, which is ecosystems, and then the third one was the uncertainty or the discomfort around AI making decisions on behalf of humans. I may be disappointing some people, but that's where I think we need to do some work together. So I'm intentionally keeping technology off the table, given I believe technology is a great enabler, but they're transient, they come, they go, they change. For me, it's a mindset. So the keyword is strategic partnerships again. And what do I mean by that? As financial institutions, we always talk about our strengths. So we talk about Lloyds helping retain prosper, and I'm very proud of that. But what we also need to do at the same time is we need to look at our weaknesses. Once we have clarity on that, then we need to look at what our future aspirations are, what we can do today, and where is the gap. So once we have mapped all of this, what is the gap between aspirations and capabilities, what are our weaknesses, then we need to go out in the market, find the right set of partners who can help and come and bridge that gap, who can build those client-centric ecosystems, platforms, whatever we may want to call those propositions or solutions, but truly acknowledging the factor that we can't do this alone, we have to do this together.
Well, now over to you. Last word is always with technology.
Thank you. So my bold prediction for 2030 when it comes to central banking it will become embedded, it will become autonomous, and it will be AI-driven. And by 2030, the banks will move from processing transaction to orchestrating industry ecosystem. I do not mean regulatory system, I mean really industry ecosystem, industry value chain. And they will become invisible and will be delivered where commercial transactions happens. And it will be delivered instantly and autonomously. Very reactively, this is how I see it. It will come sooner than we think. Maybe to visualize this, I have a privilege to be a director of a think tank in my company. It's a school, we call it School of Wholesale Banking. And it was last year, we had 25 banks across 5 continents. And I always organize dinner sessions in inspiring places. And last week, we had it in Natural History Museum in Oxford, among the dinosaurs, skeleton of dinosaurs, to make people think, how we survive. Because dinosaurs just vanished overnight. They were the biggest, the largest. James was speaking about this and Charles a bit. So what is this, what will happen? I think we are in the position as bankers to really anticipate this. It's not anymore balance sheet driven, it's revenue driven model. So technology enables us to drive profitability. IBS showed profitability traction in UK banking, fantastic, but also to drive providing true value to the economy. And this is important to keep in mind. So I think we are in a good place, and the world will look very differently when we meet in 4 years' time in Shangri-La.
So great panel, and thank you so much for amazing ideas for next 5 years, which I'm sure most of the people in the room will agree. And I'll draw closure to the panel, given we're running a bit late. But big thank you to all of you for sharing your thoughts, and I'm sure everyone enjoyed it. Yeah.